Hello, and welcome to Mission Wealth's 2017 Quarter 4 Market Perspectives. My name is Kieran Osborne, the Chief Investment Officer at Mission Wealth, and I'm very excited to present our outlook on the financial markets to you today. This presentation will cover three key themes: broadly, stocks, bonds, and potential asset class opportunities moving forward. Global stocks continue to rally in 2017, and US stock valuations in particular appear somewhat stretched. Statistically, we may be due for an increase in volatility and a potential stock market pullback. As such, our expectations for US stock returns have moderated moving forward. With that being said, global growth is the most synchronized we have witnessed in many years, and we may get a short-term boost to economic growth should tax reform pass. Turning to Fed policy and its implications on interest rates and the bond market, we expect one more Fed rate rise this year. Fed Chair Yellen is likely to be replaced in 2018, and the short list of candidates to replace her appear somewhat more hawkish. We don't anticipate inflation to rise dramatically anytime soon, but there are some factors that may push it higher in the near term. International policy is pretty interesting. International monetary policy may be hitting an inflection point with a bias towards tighter monetary policy moving forward. And all of these dynamics may put upward pressure on interest rates moving forward. So with that backdrop, where do we believe the asset class opportunities lie? Within equities, we believe opportunities may exist in international and emerging markets, given the relative valuations versus US stocks, and there are some tailwinds pushing them higher, which I will speak to later in the presentation. Core high quality fixed income may be challenged if we do go through a period of increasing interest rates, but select fixed income asset opportunities may exist, particularly in satellite fixed income like high yield or floating rate. Finally, less correlated asset classes like alternatives may provide a key role in an environment where we anticipate more moderate returns from stocks and where fixed income may be challenged, especially if we do get a reversion to more normal levels of volatility. One of the key questions we're often asked by our clients, especially recently, is how much higher can stocks go? Isn't the stock market overvalued? Aren't we due for a pullback? Well, yes and yes. This chart here clearly depicts the significant run-up in the US stocks as measured by the S&P 500 coming out of the Great Recession in 2008. So we've been on this really great run, but yet valuations do appear to be somewhat stretched, and that's what this chart depicts. You'll see that the current price to earnings multiple on the S&P 500 is at 17.7 times. It's a bit higher than the long-term average of 16 times. At the same time, we've had an extremely low level of volatility within the stock market. You'll see here on this chart that the current level of volatility. Now this chart depicts the most commonly followed fear index, that's the VIX index, currently trading right around 10, which is about half the long-term average for the VIX. So statistically speaking, we may be due for an increase in volatility, which may also create a pullback in markets. This next slide as well is a really nice one. It just depicts how many significant moves we've had each year in the S&P 500. You'll see so far in 2017, only 8 plus or minus daily 1% moves, and there have been no daily move greater than 2%. That is the smallest number since 1965. So yes, US stock valuations do appear stretched, and statistically speaking, we may be due for a pullback. But there are some positive dynamics occurring. For one, we do anticipate earnings growth to be relatively robust moving forward, with double-digit growth possible over the next few quarters. Oil in particular, the bounce back in oil helped the energy sector as they cycle relatively easy comps from last year. This slide, right, on the left I should say, just depicts that we are in the midst of the shallowest economic recovery ever experienced, now lasting 99 months. That's versus the average of 47 months. And you'll see on the chart on the right that the average real GDP growth during this current expansion has only been 2.2%. That compares to the long-term average for the economy of 2.8%. So there's this very, very slow growth economic recovery that we're currently experiencing. The impact of the hurricanes that occurred this year may produce some short-term volatility on economic data points moving forward, but the recovery and rebuild periods typically do add to economic growth. At least that's been the historical experience. And we may also get a short-term bump in economic growth should some form of tax reform come to pass. That's likely to occur in 2018. We believe something is likely to get done, though it is most likely to be a modified version of the originally announced plan. Turning to the global economy, you'll see this chart here on the far right-hand side. There's a lot of green, and green is good. This chart depicts the Global Purchasing Managers Index for manufacturing. It really depicts that we are currently experiencing some of the most synchronized global growth that we've witnessed in many, many years. In short, a number above 50 is expansion, a number below 50 is contraction. And you'll see there are no numbers below 50 currently. At the same time, we're experiencing relatively stable inflation across the globe, which should help to support ongoing global growth. So what does this all mean for stocks going forward? On this slide, I've included the forecasts from two of our investment partners, Goldman Sachs up the top and Deutsche Bank down below. One is a little more bearish and one a little more optimistic, but the same theme holds true. Given the stretched valuations and potential for an increase in volatility, the outlook for US stock returns has moderated. You'll see Goldman Sachs estimates the S&P 500 return over the next 12 months to be essentially flat, whereas Deutsche Bank expects the S&P 500 to return just under 6%. On the other hand, both forecast international and emerging markets to outperform. You'll see that in the numbers here. In fact, Deutsche Bank expects emerging markets to return about 11% over the coming 12-month period. I'll speak to that opportunity later in the presentation, but there are some natural tailwinds that may push international and emerging markets to outperform US stocks going forward, one of which is increasing growth, continued relative beneficial monetary policy abroad, as well as relative valuations versus the US. Turning to Fed policy and its implications on interest rates and the broad bond market, we expect one more rate rise this year. Fed Chair Yellen is likely to be replaced in 2018, and the short list of replacements, which as of today appear to be Jerome Powell and John Taylor, but Kevin Walsh may still be in the running, appear more hawkish than Yellen, meaning we could have more than 2 rate hikes in 2018, particularly if we do get a short-term boost from tax reform, an increase in inflation, and ongoing continued global growth. We don't anticipate inflation to increase anytime soon, and this chart here just depicts that inflation has been stubbornly low for a very, very long time. We do believe there are 3 factors that could push it marginally higher in the near term, however. Those are the oil rebound, as we cycle relatively low oil numbers and low comparables from last year. Secondly, the weakness in the US dollar. That's important because it increases the cost to import goods into the US, and the US is a net importer globally. And thirdly, the tight labor market may increasingly put wage pressure and naturally put upward pressure, therefore, on inflation going forward. At the same time, the Fed has announced that they will shrink their balance sheet beginning in October. This chart depicts the estimated forecast for the balance sheet of the US Federal Reserve moving forward. This is very important because the economy must now move away from its reliance on monetary policy as one of the key tailwinds behind it, not only for stocks, but also for fixed income. As the Fed shrinks its balance sheet, it will naturally decrease demand for fixed income. And that should naturally put upward pressure on interest rates. If you think just basic economics, a decrease in demand with no offsetting change in supply should naturally push prices lower, or said another way, interest rates higher going forward. What's really interesting right now is what's happening with global monetary policy. We believe global central bank policy may be hitting an inflection point, with international central banks becoming tighter over time. You'll see that this is the chart on the left depicts global central bank sheet expansion. You'll see that decreasing over time. But we do believe that this divergence in central bank policy that we've witnessed over recent years is abating. That divergence with the US on a tightening bias and the rest of the world essentially on an easing bias may be hitting an inflection point. As an example, the ECB, the European Central Bank, has signaled that they may scale back purchases next year, and they may even conclude their quantitative easing policies next year too. This may increase rates internationally and in turn allow US rates to move forward, unanchor the US rates. One of the key dynamics we've witnessed is that despite the Fed increasing rates, longer dated yields like the US 10-year have remained stubbornly low because interest rates globally have been at historic lows themselves, and thus anchoring US rates. And you'll see this in the top left-hand chart, where the majority of developed market 10-year yields still remain below 2%, anchoring to an extent US rates from moving higher. This may reverse itself going forward as international monetary policy does become more tighter and allows international rates to move higher over time. And you'll see that in the consensus 10-year forecasts for rates globally, with consensus estimates across the board pointing to upward pressures or upward movements on the 10-year interest rates across a variety of countries internationally, including the US. At the same time, interest rate sensitivity as measured by duration, and this is depicted in the top right-hand chart, is at its highest level in over 30 years. The duration a little over 6 years, I should say. Meaning, should interest rates rise, core fixed income, high quality core fixed income, may be challenged moving forward. So with that backdrop, where do we believe the opportunities lie? Well, one opportunity we believe is within currency, specifically related to the US dollar. This also relates to monetary policy and the changing dynamics we're witnessing currently. The chart on the left-hand side just depicts that currencies tend to move in relatively long trends, both to the upside and to the downside. We believe we're hitting an inflection point for the US dollar. This is the US dollar over time, by the way. Namely, with international growth starting to outpace US growth, while international monetary policy is becoming increasingly tighter over time. Both of those dynamics typically are beneficial for a currency, so beneficial for those international currencies and less so for the US dollar. After maintaining a dedicated currency hedge position for our international stock exposures, which benefits from a strong US dollar, so we benefited from the increased value of the US dollar, the strength of the US dollar recently, we recently decided to exit that position given the outlook for potential dollar weakness. Turning to the opportunities within equities, this is a really nice chart in that it depicts actually the same chart that was depicted earlier in the presentation, the S&P 500 and the significant rally it's had coming out of 2008, but it also depicts what happened to the rest of the world. So this purple line is the rest of the world outside of the US. These are stocks outside of the US, and you can clearly see that the rest of the world just simply hasn't participated in as much of the upside, as much of the recovery as the US has. Now, one of the reasons we believe that has caused that is that we did have this divergent monetary policy initially, especially initially actually coming out of 2008. Europe was a prime example where they viewed this as much more of a balance sheet issue and that they had to tighten down the hatches. Austerity was the name of the game that they threw out coming out of 2008. And they really tightened policy in Europe versus the US, where here we really threw the kitchen sink at the problem. We expanded the Fed's balance sheet through massive quantitative easing. And fast forward a few years, Europe realized, well, hey, we're still mired in this very low growth, negative growth environment, whereas the US is growing their way out of this crisis, albeit relatively slowly, but they are growing. And so Europe came to the realization that, hey, maybe we should follow in the footsteps of the Fed. And so they then pursued their own quantitative easing programs. So now we find ourselves at a point where the rest of the world in terms of monetary policy is somewhat lagging the US. So whereas the US is now on much more of a tightening bias and international central bank policy appears to be hitting an inflection point, international central bank policy is still easier than policy in the US and may provide an ongoing tailwind, at least in the near term, for international stocks to outperform potentially US stocks going forward. The chart on the left here just depicts the earnings growth and where earnings has coming out of the crisis. And you'll see the US has experienced fairly significant earnings growth relative to emerging markets and Europe in particular. Basically, this chart really depicts that there is a lot of runway left for emerging markets and Europe in particular to really catch up to the US. And you've seen both emerging markets and Europe really starting to turn a corner more recently. And that's somewhat been exhibited in the outperformance of emerging markets and developed market stocks over the last year-to-date period as well as 12-month period. And at the same time, whereas US stock valuations are somewhat stretched, you'll see that on the right-hand chart, international developed markets and emerging market stocks, that their valuations are right in line with their historic averages. So they're not as stretched as US markets. They're based on historic averages right in and around fair value. Turning to fixed income, this chart here depicts the impact of a 1% rise on various fixed income asset classes. And you'll see the asset classes that really get hit the hardest are the longer duration asset classes, like the 30-year Treasury as a good example of that. But there are some asset classes that do relatively well in a rising interest rate environment, particularly high yield and floating rate as good examples. Less constrained fixed income strategies, those strategies that can actively manage their duration exposure or interest rate risks and opportunistically add to select fixed income asset classes or sell out of fixed income asset classes based on the valuations that they see and opportunities that they see, may also fare well in a rising interest rate environment. The one caveat that we do have here is that, like US stocks, which have become stretched in terms of valuations, credit valuations appear somewhat stretched as well. So what we've been doing within our high yield exposures, as an example, or satellite exposures, is to really favor high quality, high yield in those buckets. Finally, in an environment with moderated expected returns for stocks, and where fixed income may be challenged if interest rates do rise, we believe less correlated asset classes, like alternatives, could play a key role in a well-diversified portfolio. This chart here depicts Mission Wealth's preferred liquid alternative investments. And we believe these liquid alternatives may hold up relatively well, particularly if we experience a reversion to more normal levels of volatility. And in particular, the highlight row here just depicts how these funds performed in the last 4 S&P 500 pullbacks of 10% or more. So when the S&P 500, which over those last 4 pullbacks, experienced an average negative return of 14%, each of these funds held up relatively well, either posting marginally negative returns or slightly positive returns. So we believe in an environment where stock returns may be moderated, where core fixed income, especially high quality core fixed income, may be somewhat challenged given a rising interest rate environment, that alternatives may fill a much needed opportunity set within a well-diversified portfolio and offer potentially attractive risk return benefits. So with all that being said, what are the actions that Mission Wealth has been taking? Well, for one, and I alluded to this earlier in the presentation, we did exit our currency hedged international stock position in favor of an unhedged international stock position to take advantage of the potential weakness in the US dollar we foresee moving forward. We continue to favor a globally diversified basket of stocks, particularly with exposures to international and emerging markets, which we believe have the potential to outperform US stocks going forward. We also favor a tilt towards satellite asset classes within fixed income, those being high yield, emerging market debt, floating rate as examples. But we are preferring high quality in those buckets, high quality, high yield bonds, as the example I gave earlier in the presentation. At the same time, we are managing our interest rate sensitivity within our core fixed income very closely, preferring a shorter duration or shorter interest rate sensitivity than the broad fixed income market, given our outlook for where rates may move going forward. We believe our portfolios are well positioned for the forthcoming period and may weather the potential for increases in volatility, a rising interest rate environment, and the ever-changing geopolitical and economic landscape. Thank you for your time today. As always, should you have any follow-up questions at all, please don't hesitate to contact your client advisor.